spike in an environment where there's that black swan, well, the banks are in trouble, the insurance companies are in trouble, the bond market's in trouble, the stock market's in trouble, real estate's in trouble. Where do you go? And I think people are realizing this. And, it's kind of a softball question for a guy that owns a precious metals company, but if people haven't figured out by now that I try to be as genuine as humanly possible, that I do as I say, they never will believe me. I will just simply say, to me, there are very few places where I think you can safely keep your money with a high degree of liquidity, where the biggest money in the world is showing you through their actions where they're going. And I think you will see that public catch on. But typically, the big money, well, they do this in the cover of darkness. I remember vividly when gold finally broke through $400. I was a very young man at that time, and gold just forever was between $250 and $375, $80. And just like we see right now with, when the market was trying to break through 2,000 in gold, or when silver is trying to, break through 44, it keeps coming up, and it would just bang its head against that resistance. And I remember it finally breaking through 400, thinking, my goodness, here we are at $400. And then it broke 850, oh my God, we're finally there. We're finally at all-time highs. And if you would have told me that we would be at nearly $3,800 on gold, and really no one hears about it. You rarely see it. Yeah, you see it on the ticker a little bit on CNBC or Fox, but it's not discussed. Jim Cramer, this idiot, just comes out and makes a tweet saying, I just wish we'd stop seeing all of this, irrational speculation in gold. And I'm thinking, you're just a moron. Where have you been the whole way? And is it irrational, or is owning stocks at the highest level of valuation ever?
Gold's history has been one of repeated resistance points, price levels that seemed impregnable. But each time gold pushed through, it redefined what markets considered possible. In contrast, silver has navigated similar fights at its own resistance levels. Meanwhile, equities are sitting at historically high valuations, often propped up by optimism rather than fundamentals. Critics, popular financial pundits, dismiss gold's recent ascent as irrational. But when one examines the macro, the argument seems backwards. When real wages stagnate, inflation erodes purchasing power, and fiat currencies falter, gold becomes one of the few assets offering real value protection.
Ever, with the largest allocation of the retail public ever, and the largest margin participation by the public ever, and the largest option participation by the public ever, as the inside money is going the other way. I mean, the guy's just an idiot, but this is why people don't get it, because unless you're spending time watching Liberty and Finance or Miles Franklin or Peter Schiff or any of the people out there that are doing this work, Vince Lancy, I mean, there's so many good ones. I don't mean to disrespect anyone by not saying Gregory Manarino. I mean, the list goes on and on and on. And if you're not paying attention, you don't see this. You don't get it. You don't know it. You may hear this and that. You may go try and buy a necklace for your wife or your girlfriend's, anniversary or whatever. You realize, wow, gold's expensive right now. But people at large don't understand it. They don't view it. It's become so removed from the collective conscious of the public. And so, yeah, I mean, the big money is waking up to it, no question. And when I say big money, I think there's a duty when you have that kind of money to think. And I'll tell you that, and I mean, I'm serious about this. Where do you put your money at a certain point is very difficult, right? You got interest rates that on the short term, the very short term interest rates, which are coming down. I think you'll see the opposite on the 10-year. Will move the other direction, just like it did before, just like we see in London, where they've lowered rates 7 or 8 times, and yet their 30-year treasury is pretty darn well near its all-time high.
Wealthy investors face a vexing question: where to preserve capital when every traditional option is compromised? Stocks may look expensive. Bonds, especially in the long end, are volatile. Interest rates are being squeezed between inflation and policy shifts. Real estate prices are elevated, leverage is high, and regulatory or financial system risks loom. Short-duration instruments like 6-month treasuries offer liquidity but fail to keep pace with inflation. Big institutional players have already begun shifting portions of their portfolios toward precious metals. They see gold and silver not just as emergency cushions, but as assets with staying power in unstable times.
The bond market controls the back end, but I wouldn't buy the back end anyway. I would own some 6-month treasuries or shorter duration, and those are coming down. Where do you put your money when inflation, the real level of inflation, is far greater than the interest that you're receiving for something as safe and liquid as a treasury? What happens if Trump gets his way and they lower rates 200 basis points to 2%? And the CPI, which is at 3.1% right now, is actually higher than the rate that is stated. Big money won't stand for that. We know that the CPI, because you've had John Williams on this show, will tell you it's 11% right now. Add an 8 to it, the way it used to be measured before they changed it. Point of it is where do you put your money? Stocks at all-time highs, bonds at not quite all-time highs, but losing demand rapidly, so much so you create something called the Genius Act, which it is kind of diabolically genius, to create synthetic demand for U.S. treasuries because the organic demand is waning. Where do you put it? You put it in real estate at all-time highs. You put it in banks that are over-leveraged and undercapitalized, where you are now a unsecured general creditor with bail-in laws. So yeah, I think there will come a moment where the public at large realizes this, but the big money is asking these questions every day. What do I do with all this money? And no one would have ever thought that having that kind of wealth would be such a pain in the ass, such a difficult thing to safeguard. And as you get older, you're more concerned about protecting than you are making, because you're thinking of your children and your grandchildren, and how do I pass it on appropriately?
Inflation doesn't just show up in commodity indices. It's felt in daily life. Tuition, healthcare, rent, everything priced in dollars is eroded. A striking historical example. In 1978, a student working summer minimum wage could earn enough to pay public university fees and even buy gold, 7 ounces, which today would be equivalent to tens of thousands of dollars. As of 2025, gold has outpaced inflation significantly, preserving purchasing power that fiat currencies have lost. For those concerned about legacy and wealth passed to future generations, gold is increasingly seen as a bridge across time, something real in a financial world of shifting definitions.
Interest rates spike in an environment where there's that black swan. Well, the banks are in trouble, the insurance companies are in trouble, the bond market's in trouble, the stock market's in trouble, real estate's in trouble. Where do you go? And I think people are realizing this. And, it's kind of a softball question for a guy that owns a precious metals company, but if people haven't figured out by now that I try to be as genuine as humanly possible, that I do as I say, they never will believe me. I will just simply say, to me, there are very few places where I think you can safely keep your money with a high degree of liquidity, where the biggest money in the world is showing you through their actions where they're going. And I think you will see that public catch on. But typically, the big money, well, they do this in the cover of darkness, where you got guys like, Jim Cramer, moron, saying, it's too speculative, it's frothy. They're not looking at this the right way, and they're not really part of it. But there are a lot of people who are clued in and understand where we're going and what's happening, that are buying gold and silver as a life raft. And that's the way that I look at it, but not just for an emergency, right?
Multiple forces are converging. Central banks are aggressively increasing gold reserves, worried about U.S. dollar dependency, geopolitical tensions remain high, inflation, though seemingly contained by some metrics, is persistent. Interest rates are expected to fall, easing pressure on non-yielding assets. Analysts, including major banks like Deutsche Bank, have raised forecasts for gold toward 4,000 plus per ounce in the next year, citing these pressures. Meanwhile, ETFs are seeing renewed demand. Private investors who ignored gold during earlier decades are now considering it a central pillar of diversified portfolios.
It's for an opportunity as well. And maybe having that dry powder in the form of something that is keeping its purchasing power against a dollar that's down 11% this year and gold up over 40, it's keeping its purchase. You go back as far as you want, and I can make this analogy in real estate and in anything. Gold maintains its purchasing power, and most other items across the board, from food to energy to real estate, measured in gold, it's becoming cheaper and cheaper and cheaper as things measured in dollars are becoming more and more and more and more expensive. You can pick anything you want, automobiles, college tuition, and I have an answer for it. And that's the scary thing. I wrote one thing down to kind of show that. It just kind of caught my attention. And it's just very simple. In 1978, a student working full-time summer job at the minimum wage of $2.65 an hour could earn roughly $1,378, which was more than enough to cover the average tuition and fees of $688 at a public university. So when you talk about inflation outpacing standard of living, it's extraordinary. But if you look at gold at its value, since 1978, when it would have been priced at, I don't know what it was back then, a few $100s anyway. But point of it is that, look at where gold is today from where it was then. In fact, let's just look real quick just to make the point. We'll see where gold was in 1978. What was average gold price in 78? Was $193.4. So if you are earning minimum wage and you're able to make, what did they say, 1,378. So 1,378 divided by 193.4. You would have bought 7 ounces of gold with your minimum wage summer job that today would be worth $26,000. So that would cover your tuition in most public schools. A lot of the highfalutin ones are going to be 3 times that, because college is probably a poor example showing how much it's outpaced itself. But point of it is that what is $1,100 worth in fiat versus in this term. I just think it's important to understand that gold and silver have done a wonderful job in the face of a dollar that is destined to continue to lose purchasing power and probably accelerate, because that's the whole premise of what they're trying to do, not only of what Trump wants to do, but Stephen Murin, who's now on the Fed and the architect of the Mar-a-Lago Accord, which speaks of a weaker dollar to stimulate and bring back manufacturing. So saving in dollars are destined to go broke, period.
So where does that leave someone who wants exposure without reckless risk? Cost averaging is one smart approach. Investing in small amounts over time lowers the danger of mistiming a peak. Holding physical gold or allocation via gold ETFs ensures liquidity. Diversifying away from long-duration bonds and overvalued equities helps. Be wary of political risks that may affect currency and policy stability. In particular, any potential erosion of central bank independence might accelerate the move toward gold. If gold continues its current trajectory, it could reshape the global monetary order. Gold may not merely be insurance, it may become a core asset in a more trust-based financial architecture.
If you have $100 to spend, waiting for it to pull back, instead spend $25 a week for 4 weeks. You'll smooth out the uncertainty. The people who are the talking heads saying that gold and silver are top heavy and are going to correct, maybe it is, maybe it isn't. Maybe this time it's different. I mean, when you get to the end of a cycle, like we're seeing right now, a monetary cycle, maybe a reset, a reshuffling of the monetary deck, where gold and silver are becoming more central to, I think, the plans. Silver for national security on many levels, and gold for the backing of a new monetary system that is one that's built and centered around trust. waiting for that pullback might be silly. You might turn out to get really lucky, and maybe it is a great thing. But instead of putting all your chips on red or black, why not just, cost average your way? And that's probably a more measured, safe way to make sure that you don't miss out. And in retrospect, which is always, hindsight 2020, maybe it would have been better to wait, maybe not. So I would choose to, fall on the side of cost averaging in smaller amounts, which you can always increase your speed if you feel the need to, or you see something that concerns you, or slow it down. So that would be, I think, a more prudent way to proceed rather than speculating, if you will, on something that you want to have in your portfolio.